Recently, Federal Reserve and Federal Deposit Insurance Corporation have found weaknesses in the living will plans, also called as resolution plans, of four banks: Bank of America, Citibank, Goldman Sachs, and JP Morgan Chase. To understand living wills or resolution plans, we need to understand the background of 2008 financial crisis. When people buy homes, they often take out loans called mortgages from banks. Banks bundle many of these individual mortgages together to create a financial product called MBS, mortgage-backed security. Banks sell these MBS to investors who receive the mortgage payments from homeowners as return on their investments. In United States, in the period up to the 2008 financial crisis, home prices were rising rapidly. Many people bought homes with the expectation that prices would continue to rise, and when needed, they would sell the house in future at profit. Banks provided easy loans at low interest rates, so it becomes cheap to buy homes, and more people started buying homes. And banks, on the other hand, started giving loans to people who had poor credit history and were likely to default on their loans. And because of that, MBS, that is mortgage-backed security, became very popular with investors because they offered higher returns compared to other investments. MBS was a risky investment because if the underlying mortgages or loans gets defaulted or unpaid, then the value of this MBS would fall, and so does the returns on MBS. Banks and financial institutions had large amount of mortgage-backed securities or were involved in insuring those mortgage-backed securities, ignoring the risk associated with MBS. Then the crisis unfolds. Borrowers began to default on their housing loans. The value of MBS that included these risky loans started to drop. The housing market crashed. Home prices began to fall, making it even harder for the homeowners to refinance or sell their homes. So more people defaulted on their loans. Banks and financial institutions that invested in MBS and were insuring MBS suffered massive losses. In September 2008, Lehman Brothers, a major global financial services firm, filed for bankruptcy. In March 2008, Bear Stearns, a major investment bank, faced a liquidity crisis and was sold to JP Morgan Chase. The widespread defaults and falling value of MBS caused panic. Investors lost confidence in the financial system, and banks became hesitant to lend to each other. With banks unwilling to lend, businesses and consumers found it difficult to get loans, leading to a severe credit crunch. Lack of credit and loss of confidence caused businesses to cut back, outflows leading to job losses and a significant economic downturn known as the Great Recession. Financial institutions around the world had invested in US MBS, spreading the impact globally. Government and central banks worldwide had to step in with massive bailouts, stimulus packages, and monetary policy interventions to stabilize their economies. A bank bailout involved the government providing financial support to the banks that are on the brink of failure. Government uses taxpayers' money to bail out banks. Let's understand what is living wills. Resolution plans, also known as living wills, means having a clear and well thought out plan for how a bank will handle things if it gets into serious financial trouble or goes bankrupt. This plan ensures that bank's closure or restructuring happens in a controlled and organized way, minimizing harm to the economy, its customers, and the broader financial system. So why US Federal Reserve made living wills regulations for banks? The 2008 financial crisis showed how the failure of large banks could lead to widespread economic problems. Living wills are designed to prevent such crises by making sure that banks have plans in place to handle severe financial distress without causing chaos in the financial system. During the 2008 financial crisis, taxpayers had to bail out failing banks. Living wills aims to reduce the likelihood of needing such bailouts by having predefined plans to deal with failures. The usage of taxpayers' money to bail out failing banks faced severe criticism. So living wills helps protect the interest of customers, investors, and other stakeholders by ensuring that the bank's failure is handled in a way that minimizes losses and maintains confidence in the financial system. To avoid the repetition of 2008 financial crisis, recently US Federal Reserve and Federal Insurance Deposit Corporation of America have found weaknesses in the living will plans of Citibank, JP Morgan Chase, Bank of America, and Goldman Sachs. Remember, these four banks are large financial institutions with global presence. If these collapses, it will disturb the entire global economy. So now we know living wills were introduced in the USA after the 2008 financial crisis to ensure banks and financial institutions would function smoothly under financial distress without government interventions. It's a common question that will 2008 financial crisis repeat again? Although the global economy is in chaos, on the one hand, inflation has hit the consumers hard. On the other hand, major economies like US, UK, and Japan are showing signs of recession. China is facing real estate crisis. To know more about China's real estate problem, watch our previous video. The link is in the description below. Since in the 2008 financial crisis era, banks took too much risk and the risk appetite was too high. After the 2008 financial crisis, central banks across the world have put a cap on risk appetite of banks. So it's less likely to have 2008 financial crisis again in same format. Please like, share and subscribe our channel to get fresh economics and finance content.